Thanks for tuning into today's Talking Point. I'm your host, Niraj Shah. The case for a chat today is centered around what could happen to equity markets, of course, but are Indian valuations still attractive? And one could look at global valuations and try and argue that maybe they aren't, but look at historical valuations and argue maybe, just maybe, there could be some more room as well. Would DI inflows further offset the impact of FPI outflows? And what are the expectations out of general elections 2024? Is it a done deal, or does a result still evoke some response from risk assets? All of this and more with our guest today, Venugopal Garre. He's managing director at Stanford Bernstein, joins us right now on the show. Venugopal, good having you. Thanks for taking the time out. Just trying to understand from where you are perched, how do you look at India relative to the rest of the comparable region? And what do you think 2024 holds in store from where we are right now?
Thanks, Niraj, for having me on the show. I think this realizes the first time I'm actually on air with you guys, so thanks a lot. I think India is in a pretty unique situation. There is a global excitement brewing towards India for a lot of right reasons. Part of that is the fact that macro has, been seen a pretty good recovery of the lows, and India stacks up pretty much as amongst the best performing emerging markets globally in terms of overall GDP growth as well. But the reality is that if you were to just look outside of India, normal comparables usually happen with China, which has been the one dominating a lot of these emerging market funds. And also in terms of global allocations as well, valuations there have compressed, of course, quite a bit in the recent years, and has been an ongoing process for last year as well. So the gap has expanded fairly widely. Now, normally valuation calls itself are usually not taken as a gesture in terms of how to approach investing in a particular country, because you do tend to look at the structural and cyclical factors as well, which is where India is still favored. But I would probably argue that compared to where we were 12 months back and where we are right now, and even in relative sense, valuations very clearly look excessive. There might be still pockets of opportunity, but across the board, it is becoming a bit more tougher to argue even the growth angle. You have to really discount a lot of things into future, expect, and be a bit more imaginative with which, in terms of how to look at price to earning multiples, or build probably an earnings growth which might last much longer into the future. So these are the challenges that I see. One characteristic way I sort of represent that is that over the next 15 to 20 years, I guess at the top line, top down index level, the large cap index has to deliver anywhere from 12 to 13% earnings growth, on a sustained basis. That's a pretty large compounding that one has to expect. And for mid caps, around 17, 18% over the long run. Now, these are not very easy to achieve when you look at from a long periods of time. Of course, you could achieve that over a shorter period. So this is where I guess is a challenge that somewhere down the line, we have to see some form of a flatlining of the markets, which is what we believe should happen this year.
In some sense, Venugopal, you could argue that relative to some of the other very attractive markets or high-performing markets we have, right? We were looking at a statistic, while 2023, India also did well, but relative to Nikkei, hardly anything. This calendar year, I mean, a market like Nikkei is up 18%, India, for all the fanfare, is meandering around a 2% gain. So in some sense, the large caps of the Nifty headline has kind of flatlined to marginally higher relative to maybe other markets, or relative to some of the stock specific action that we've seen already.
Yeah, but the very simplest way I look at it is that India, end of the day, is an emerging market. It is always better to compare ourselves with how emerging market constructs work. The funds are very different as well. You can't have an emerging market fund investing into Japan, for example. And Japan has its own story, but look at the currency as well. So if you weren't really well hedged, of course, you would have lost a lot in currency as well. But the reality is that if you compare with Latin America, for example, where growth rates are still very meager, for a lot of these countries, or outside of that, even in ASEAN, which are a bit of them commodity driven, or even China, India might look up really well in terms of overall macro construct, not just for history for last year, but for today as well. But the reality is that the question simply is, number one, is it priced in? Number two is that from an international fund flows perspective, if you're not going to see some of these larger countries do well, which is, let's say, China, you tend to see a lot of redemptions happen. So it automatically restrains the ability to sort of see a fairly large FII flow happening into India from that perspective. Now, India as an own asset class is something that we could talk about, but we are still too early to be in that situation where you can raise money, let's say a $1 billion raise just for India alone. I don't think we are in that situation right now. I could argue that 10 years later that could happen. So that's where the challenge is, right? The constraints of FIR flows and how you approach investing. Maybe for a retail investor globally, he has a choice of investing everywhere or anywhere, but it is not the case for funds. So you need to be cognizant of that.
And that's such an important point. Venugopal, could you just kind of talk about that for a little moment? Because
Yeah.
I have heard very divergent views around the more popular opinion that China's loss could be India's gain, and the same, and that emerging market ex-China mandates are increasing by the dozens, if you will. And at the same time, I see analysis which says that while there is so much fanfare around it, the absolute numbers are very underwhelming. And it is some time away before we talk about this, which is something that you alluded to too.
Yeah, it's a fair point. Believe me, all of us like telling stories, and you actually raise a lot of money through storytelling. Of course, storytelling needs to have a fundamental background and backing as well. If you go wrong, you go wrong after a few years. So that's the part and parcel of how investing works. But if you were to think of it, China, a lot of money did get pulled out over time. I think some of it was an early call people took on the cyclical aspects of China. Some consider it as a structural challenge, but I call it cyclical. So whatever it, some took an early call and some capitulated later on because fund performances were not good, and you had to capitulate. And then of course, funding was getting pulled out. Now these are large funds which are primarily funded through, let's say, endowment funds and others. So these are asset allocators who take a call. Now, when you pull out that money, the simplistic thought process is that you are primarily either investing and reallocating that to fixed income or to the developed world or to something else. It could be another asset class, maybe crypto, whatever. So that's basically the way these things work. Now, the reality is that a lot of this money, which is allocated by these asset allocators, also goes into private equity, right? So it's not just public market is only one phase that we see. A lot of challenges are being seen in the private market, the VCP market, for example, in some of the established countries like China. It is very difficult to get your next round funding, come closer to IPOs or raise money or list. So when you get that opportunity, you basically use public markets primarily to create liquidity for yourself. That's why that money which is creating liquidity for these asset allocators is not coming back to India. I mean, if that was the case in the last 2 years, if you were to accumulate FII outflow and inflow, we've not really seen any inflow. If it's in India a shining story, why haven't we talked about $30 billion inflow every year for the last 2 years? It's actually 30 of outflow, and we probably got some inflow, which probably neutralized it, right? So that is the reality right now.
So well put. Venugopal, thanks for that. Now, within this construct then, what could mean, or what could be the positive for an Indian market watcher? Because flows, even if they come, can take valuations only as much higher. In a world wherein higher for longer rates or higher than the previous 15 years rates is a reality, and therefore multiples likely, ideally, should be compressed. So what could turn the tide? Because earnings growth, no matter how well we do, will not be at a clip which could justify higher valuations, right? So what do markets do then? Do they flatline for the next 12 months?
Yeah, so what comes to help normally at times is a cycle, right? So cycle, what does cycle actually mean? Cycle means a string of EPSs or earnings growth of a certain level continuing for a longer period, right? So this is not about 18% growth for 2 years and you go back to 6% growth, right? So that's, of course, a very challenging situation. But you have a slightly longer cycle where you have 7-8 years of, let's say, a 15% growth. Right? So what does happen is after some point of flatlining, you tend to again start to see that earnings growth give you the return. So in a very simplistic way, if price to earnings for an index or any stock does not change from here, right, and assume this is the new normal based on India's positioning in the world or the ROE perspective, asset light companies, whatever, let's assume this is the right multiple. And thereafter, ideally, you're going to get your earnings growth as your returns. If you're going to get 14-15% returns per year, let's say, from the compounding aspect, that's not a bad idea to be in equities in general, right? The challenge for us has been that we have risen very swiftly in terms of price to earnings, and this level itself looks unsustainable, right? So you do see flatlining as a broader concept from a market level, which is what we have been arguing for this year. I'm expecting 8% returns for Nifty, for example. And my argument is you get that much for fixed deposits in general. Of course, their taxation aspects might be different, but then what's the fun of being, actively involved in equities? But then you get bottom-up ideas. Bottom-up ideas are relevant across every cycle, so that doesn't matter. That's not a unique aspect to it, right? So that's like a situation today that I see. But the only positive aspect, as you mentioned, for India is that we do believe that we are in a macro cycle which could last for a couple of years, right? Maybe not the 2003 to 8 or 2003 to 10 super cycle. We probably saw 25 to 30% earnings growth on a CAGR perspective. But can you deliver 15% growth over 6, 7 years? The answer is yes.
In which case, before we take that break, one final question before the break, Venugopal, which is that I heard you say that bottom-up ideas might be par for the course, and that's true, as you said, for any cycle. My question, therefore, is SMIDs, very strong earnings growth potential on a bottom-up basis, maybe relative to large caps as well, if you look at the overall universe, even if you look at the investable universe and not the 6,000 stocks. So is there, even for global investors that you guys might be catering to, is there a tilt towards SMIDs, or is there a preference for large caps in a bottom-up world?
Yeah. So I mean, I would say that the importance of SMID as a area to invest and look for opportunities is increasing every year. Last couple of years, it was primarily about retail investors in domestic mutual funds, which are again funded by retail. Internationally, it used to be sort of a very niche process. Certain funds would probably look at alpha by investing in some set of mid caps, right? We are actually starting to hear pretty tremendous focus from a lot of funds globally on seeking and trying to understand the mid cap opportunity. But I have always been of the view that it is very difficult to invest at a broad-based basis in SMID if you don't really have capability. So first thing you need to build is hire people, build capability, understand stocks, and that is how bottom-up investing works. Sitting somewhere in the US and having somebody who's done China for 20 years, you suddenly want to invest in SMIDs does not work. It's a recipe for disaster because SMIDs can be very dangerous as well when it comes to bottom-up picking. You have to be very careful about, the business model and governance. Maybe large caps you can scrape through, because what are large caps? Large caps basically were SMIDs which delivered over time, and that's why became large caps. So risk element is usually lower, right? So one thing I want to highlight here is we started our India SMID portfolio for the first time ever this year at a hefty SMID valuation, because we really wanted to basically build this portfolio over time, because I think this is the future of India.
He believes SMIDs are the future of India. Now, I have 5 minutes on the segment, so I'll have to do a bit of a rapid fire. But Venugopal, I'm trying to understand. You've constructed a SMID portfolio at these valuations. Where is it that you've given the highest weightage in the portfolio? What theme?
Yeah, so I'll just tell you that it was a big struggle to identify stocks. I can assure you, when you try doing bottom up, you realize how tough it is. So what I did is that I realized, firstly, that it is no point allocating everything to equity. And it's a slightly long-term portfolio. I want to basically build it over the next 12 to 18 months or 24 months. So I have 80% allocation basically to somewhere down the line to non-SMID, which is fixed income, which is almost 50% allocation, and 30% allocation to large caps through a separate India portfolio, which I run. So technically, 80% is not SMIDs. The remaining 20%, we thought the first theme that we're going to choose is where there's an opportunity for non-linearity, as I say. So this is basically manufacturing, where I felt that while valuations are steep, 50, 60 XP, but there is room for earnings growth and sudden surprises to come in, because this is a phase where business is getting built for those companies. So there are 4 stocks out there which are primarily linked somewhere down the line to manufacturing, or one is an EV linked company moving from a normal traditional to EV, which is an auto component company. 2 of them are. One is an EMS player, the largest in India. One is again an EMS component player, more towards PCBs. And the 4th one is a logistics company, which has, in my view, also a linkage with manufacturing. So there are 4 stocks allocated, 5% each right now on the SMID portfolio.
Very interesting. Not surprised that some EV plays feature out there. But it's interesting that you are playing such a low weightage to SMIDs as well, because as per the market cap too, like 71% or 70% for large caps, 30% is still SMIDs. So you are underweight that bucket. But within that, EMS finds such a lion's share in your portfolio? Those valuations aren't exactly cheap, Venugopal. So why this preference for EMS stocks?
Yeah, so when I looked at the broader market, I wanted to get certain things like certainty of near-term earning streams, right? And how do you get a certainty of near-term earning streams? Is there are two approaches, actually two sets of business models which give you that certainty. One primarily is, let's say, capital goods linked companies which have order backlogs. So you have an idea of what revenue growth and what margins they would deliver. So they won't suddenly disappoint you, meaningfully. And the second one was emerging sectors such as primarily manufacturing, where there are order backlogs and you have a visibility of very high growth, at least in the near term. But then between this, manufacturing was critical for me because I think this is at least a 10-year theme. Number two is there are a handful of companies like these which I have selected who have access to production linked incentives, which primarily means that they become a conduit for any foreign company thinking of setting up, capacity in India. These guys already have an advantage of 10% plus on table for you, right? So which is a reason why they tend to gain market share in that process. So think of another laptop company coming to India, right? Which is going to be the natural company they would go to. Somebody who has a PLI, who has labor ability to gather labor, has some skill sets. So I felt that you could see non-linearity. By non-linearity, just to highlight that, I just at a 50, 60x company, which is trading at that level, even a high growth, is usually tends to be discounted, right? But then the reality is that if you're, let's say, $100 of revenues that you are generating today, and suddenly, let's say Apple comes into India incrementally, of course, in terms of new lines, and say, hey, you know what? Let me just allocate some part of my volumes now to you, right? Suddenly, what happens is 100 becomes 150. So it's not about a specific case I'm saying, but what I'm saying is that when opportunities are abound in that area, you have a tendency for a disproportionate scale up for some of the companies. And that's the reason I decided to digest extremely excessive valuations for that set and still keep it in the portfolio.
Got it. Venugopal, we're out of time completely, but I can't resist asking you a 30-second answer if you can.
Yeah.
Can election verdicts, if it's pointing towards policy continuity, still be a surprise, or is it discounted now?
I think policy continuity is already priced in the markets. And a much larger than expected mandate might lead to some euphoria where you get even more excited, in terms of what all the existing government can achieve in the next 5-year term. But that is the only element of surprise left, right? We're not even thinking about a negative surprise right now. It doesn't look like that's going to be the case in this election.
Okay, Venugopal, this was lovely talking to you. Thanks for taking the time out and speaking to us, and look forward to have you more often on the channel.
Thanks.
All right, that's the view from Venugopal Garre, and that's all the time that we have on this edition of Talking Point. Thanks for tuning in.